Welcome everyone. My name is Trent, and if you're new here, please click like and subscribe. We'll start with looking at SPY on the weekly chart. I'm going to do a quick weekend update for you here. On the weekly candle, we have a small wick up on top here. We have a higher low and a higher high. The close was essentially equal to the previous all-time high. We have yet to find price acceptance above the previous all-time high, though we had a look above and rejection on Friday. As of now, we are in between the last gap up and the previous all-time high, maintaining the possibility of staying in a lockout rally. As you can see on the weekly chart, our higher low was here, our higher high was here. We got all these gaps in between, and that's actually the daily chart, but irrelevant. The daily trend is also clearly in an uptrend with higher high, higher low, and we certainly have room to afford a higher low at this point, a new higher low. It's not been uncommon on FOMC week when we're in a strong bull run to see some people sell their positions and get some kind of pullback before prior FOMC conferences. Likely that's due to people that don't want to gamble the FOMC decision. So let's take a look at some places where we could possibly see a higher low. One of these places is right here at that last gap up, the close of that gap, and then a reversal right around 603. If we saw a higher low coming in our immediate future, it probably would be at that 603, and then a reversal from that gap close. Let's take a look at what that would look like. So as you can see here in this first kind of trade idea I posted, getting a move down, closing that gap, maybe a double bottom, something like that, bouncing back up, creating probably a higher low at 605.40 as well as one at 609 if we get above that previous all-time high and then beyond. A good entry for that would be after we see that kind of first rejection, first higher low forming, kind of enter there right around 604, maybe putting a stop. 602, $2 stop, targeting previous all-time high of 609. Now, depending on what's going on with earnings this week, depending on what's going on with FOMC, if we have strong market news out of all that, it would not be unreasonable to hold your trade, possibly all the way up here to the market maker expected move high of 616.43, which would be crazy if you held that high. But you would need some type of trailing stop to manage that trade, or you would probably get screwed. So if we dropped below 603, which is still a possibility, and it would still be bullish, we could get a higher low right around here at 599.70. 599.70 is our previous high before creating our new current higher high. So see price coming down, stopping right around 600. Maybe it goes a little below, maybe it stays right at it, but bouncing off that level, which should hopefully act as support as it was previously resistance on top of a previous range we were in for a couple weeks. So you could catch it, you could catch the bounce off that, set a stop down below this low down here, ride that up to the previous all-time high and beyond, depending on earnings, FOMC, how all that stuff hangs out. Those would be two good trades on SPY. As I talked about earlier, we are seeing a lockout rally on SPY, which just means we're gapping up, we're not closing gaps, and we're not getting any kind of substantial pullback. We saw this back in October of 2023, if you want to take a look at the charts, and we are currently, as of Friday, holding above that gap up. Let's say Monday comes around and we kind of range above this gap up and break to the upside. You could probably catch in at a higher low above 609 and ride that up with some type of, you could target all-time highs with a real tiny stop and be about a close to a 1 in 3 risk reward, or try and hold higher once again, depending on FOMC earnings, all that stuff. If it breaks to the downside, you might be able to catch a lower high below 605.40, targeting 603. I would not have a lot of faith in trying to target anywhere lower than that. There's a lot of reasons that 603 is a good spot for higher low. I mean, that location for high low makes the most sense because it's the previous all-time high. There's a gap close there. It's the top down. It's the top bound or support from the prior range you were stuck in. And it's within the bounds of the expected move on the options market. Price staying above 603 would be an absolute bullish signal, and I would be looking to get in with any kind of good risk reward situation right there. Let's say that price dropped below this 599.70, aka 600 mark. And what kind of situation that could potentially put us in. With that, if we drop below that level, kind of hit this 595.65, started coming back up for what appeared like a higher low, we now open up the possibility for a possible higher low location at 603. I mean, I'm sorry, a possible lower high situation at 603, which I don't know why TradingView wants to do this right now. I guess I'm logged into another computer, but we're going to have to deal with it for the time being. Could open up the possibility for that lower high. So not saying that's what would happen. There could be a lower high down here, but it opens up the possibility for that higher low. And with that, you want to exercise caution should price skip below this 599.70 mark. So speaking of FOMC, if Jay Powell comes out with a Powell and says something in the market's not expecting, technicals are out of the window, and depending on what he says, we could just see a massive move to either directions. So be extremely cautious with FOMC. Never recommended to have trades open during FOMC, as anything could happen. And technicals are completely out the window. Right now, there's a 97.9% chance the Fed will do nothing with interest rates on Wednesday. We're currently pricing in June is the most probable time for the next rate reduction, with a 45% chance of a quarter point basis reduction. The Fed will rarely, if ever, surprise the market. And while unemployment is currently rising, it's nowhere near alarming, so I don't expect the Fed to take any action on it. We're still a long ways to go in hitting that 2% inflation goal. Rates are probably going to stay higher for longer, and at this time, I can see no reason that the Fed would decide to cut more than one time in 2025. That said, if Jay Powell says a single word relating to no cuts this year, or even possibly even a hypothetical about raising rates, then a pullback following FOMC would be a completely reasonable reaction. I want to switch us over and take a look at the market internals, because they've been doing something kind of bizarre. All right, let's take a look at VOLD over here. You're going to see that on Thursday and on Friday, the flow volume was starting to fade out. VOLD measures the difference between the volume of stocks trading upwards, up value, and the volume of stocks trading downwards, down value on the stock exchange. So that indicates the overall market sentiment by showing whether more buying or selling pressure is present. Okay. Thursday and Friday, you could see it's faded out compared to priors. Okay. Also, take a look at ADD. Wednesday, Thursday, Friday. We peaked at 866 on Friday, which was actually a red day. And on Wednesday, we were from negative 948 to opening at negative 158. That was a gap update. I think that was the day I posted that I was suspicious of this up move due to market internals. Okay. So ADD being way down here with a bull move straight up is completely and absolutely divergent to what's happening with price on the chart. Also, take a look at tick. Wednesday, Thursday, Friday. We spent the majority of our time in the negatives as opposed to positives, like a normal bull movement. And that's just another divergent indicator showing what's happening on this market, okay? All these market internals are in complete divergence to the trend we are seeing on the charts. And I'm not sure we have a logical reason for why that is. We do know that this most recent rally was caused by the Stargate project. You know, I did say earlier last week, I was suspicious of the up move due to market internals. And though we hit all-time highs, and though we appear to be in a lockout rally, with these kind of internals, I am seeing a red flag with that. And it's saying something out of the ordinary is happening here. So watch your ass. I don't know when you don't watch your ass when trading, but watch your ass. And earlier I was taking a look at earnings expectations for the coming year, and they are going down. They're kind of dipping off a cliff. This is probably due to the outlook of holding interest rates higher for longer, which would make it logical for earnings expectations to be cut down in the coming year. Also, take a look at Japan. Their interest rates are being raised. They're expected to continue to get raised. And this is because their inflation rate is somewhat drastically increasing, continues to. And I'm not going to be the one to dare say we're approaching a market top, but I will say we are starting to see some signs outside of price movement that the market could be getting low on gas. We just have yet to see that reflect in the price. Price does rule above all these other technical fundamental indicators, but they are creating a divergence. And due to this, I would exercise caution in the long-term trades and be more focused on the day-to-day price action. That's what I got. Be prepared for a very active week on the stock market and use good risk management.